Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SoFi Technologies SOFI stock, and in this video, we're going to be comparing SoFi Technologies against other traditional banks as well as other fintech companies and neobanks. So if you want to see this comparison, go ahead and smash that like button right now, comment your thoughts down below, subscribe if you are new, don't forget to become a member of this channel for as little as 99 cents to support me personally because that's what keeps me here on YouTube, but if not, by subscribing, you're going to get this content for absolutely free. And with that being said, I say let's just dive right into today's stories. SoFi Technologies, if you didn't know, is a fintech company or a financial technology company that essentially operates as a digital bank, and they have been extremely popular in the overall stock market, and we've been reporting on this company for quite a while now. So in this video, I really want to dig deeper into their overall business model and what differentiates them from other fintech companies, because in this video, we're going to be comparing them against some of their fintech and neobanking peers as well as traditional banks. And this is just going to fortify the bullish stance which I already hold on this stock, but I want to make you aware about why this company is so fundamentally solid. And we're going to start off talking about their roadmap to success, starting with their CEO, also known as their Chief Executive Officer. Their CEO is Anthony Noto, who is a former investment banker at Goldman Sachs, and he also served in the C-suite at both Twitter as well as the NFL, or the National Football League. And this is going to help SoFi succeed over the long term. But that's not all. Over the last few years, SoFi Technologies has acquired a number of different companies because management, shareholders, as well as the CEO, has used SoFi Technologies to acquire and buy other companies such as Galileo, which is a banking-as-a-service platform, Technisys, which is another technology platform, as well as Wyndham Capital, which is a mortgage firm. And all of these acquisitions were exquisitely done, and all of them benefit SoFi Technologies and their long-term vision, which means they are setting themselves up for a roadmap towards success. All of these deals have helped SoFi substantially, even beyond what traditional banks can offer. And remember, SoFi started off by refinancing student loans, so clearly they have come a long way since that point, even though right now they still offer student loan refinancing. Now, since we have somewhat of the roadmap on what the future holds for this company pertaining to new revenue segments that SoFi already has obtained through their acquisition and through the networking capabilities of the CEO, instead of just being a student loan refinancer, now let's talk about how their business model is not only going to keep them successful, but also catapult them to future success. SoFi Technologies essentially is a one-stop shop for all banking needs and even some investing needs. The backbone of the business is their ability to cross-sell and upsell existing members in the company, but they also have a huge competitive advantage in regards to marketing and sales because they have an uncanny ability to bring in members and customers from the market or even steal them from other banking institutions. As an example, during the first quarter, which ended on June 30th, SoFi boasted 6.2 million total members on their platform, which represents 44% growth year over year in their member acquisition. So they are doing phenomenal in regards to their marketing efforts. And as they bring in new members, this allows their business model to take effect, which is a flywheel business model to cross-sell and upsell them on other products. I've said this in previous videos. For instance, if you joined SoFi Technologies just to get their credit card, they're also going to try to upsell you and cross-sell you on, hey, what about a personal loan or refinancing your student loans, or how can we help you by setting you up with a checking or savings account? And they do this really well because not only do they want you to use other products that they offer, which ultimately gives them revenue, but it also allows you to have a place where all of your financial needs are met instead of having multiple finance or investing apps. This has also led SoFi Technologies to be very successful in their overall revenue generation. For instance, during the second quarter of 2023, they brought in revenues of almost $500 million, bringing in $498 million, representing a 37% CAGR on a year-over-year basis. And their compounding annual growth rate in regards to the revenue is very impressive, especially when we start to compare them to other fintech companies, neobanks, and even traditional banking institutions, which we will do later in this video. So now that we have their roadmap roadmap and their ability to scale their overall members and revenue, let's take a look at their valuation pertaining to their share price, because as an investor, we want to get good deals on the companies in which we are purchasing shares in. However, we're going to start off by comparing SoFi Technologies by using their overall PS ratio and PE multiples. As of right now, SoFi Technologies' current market capitalization is $7.7 billion and their enterprise value is around $11.4 billion. SoFi Technologies is valued lower, which is good, than many of their private competitors such as Stripe, Chime, and Plaid. Now, I know it's very hard to compare a publicly traded company like SoFi Technologies with private companies such as Stripe, Chime, and Plaid, but overall, it seems that SoFi has a better valuation than all three of those companies. But now, let's compare SoFi Technologies to some of their direct peers, both in the neobanking space and the traditional banking space, using their price-to-sales ratio. And if you see the chart on screen right here, we have companies like SoFi Technologies, Wells Fargo, JP Morgan Chase, Morgan Stanley, the Goldman Sachs Group, as well as New Holdings. And it seems that from this chart, the only company that is trading at a higher premium than SoFi Technologies is New Holdings. And if you're not familiar with New Holdings, they are a fintech company in Latin America, and they are trading at a PS ratio of 8.24%, which is very high. On the other hand, we have SoFi Technologies, which is much closer to their peers, coming in at only 4.1, and then we have JP Morgan at around a 3, we have Morgan Stanley at a 2.8, we have the Goldman Sachs Group at 2.5, and then at the very lowest we have Wells Fargo, even though I don't like how Wells Fargo is run, which is why I personally don't own them, but I do own Morgan Stanley, JP Morgan, and Goldman Sachs, as well as SoFi Technologies and a little bit of New Holdings. So essentially I hold all of these companies except Wells Fargo. I just don't think that they are a very good company. Now, I do think they could make a comeback in the future once they get some things ironed out, but as of right now, don't let their very attractive PS ratio lead you astray. Now, when it comes to the price to sales ratio, there is a metric that we can use to discount them compared to their peers. And what do I mean by this? Essentially, if their CAGR in regards to their revenue growth rate is very high, substantially higher than what their peers are bringing in, then their overall valuation is justified. Essentially, let's take Wells Fargo, for example, because their PS ratio is about 2, and let's just say SoFi has a PS multiple of 4. If SoFi's revenue compounding annual growth rate, which is currently around 37% right now, is 2 times higher than Wells Fargo, that means that SoFi Technologies is a better buying opportunity, not only in regards to their PS ratio, but also other reasons. So even though we see a relatively high PS ratio compared to some of their peers, their compounding annual growth rate in regards to their revenue, which will lower their overall PS ratio over time, is far more competitive than the majority of others on this list, and I used Wells Fargo as an example of that. The same would go for New Holdings. If New Holdings is growing twice as fast as SoFi Technologies, that means that they are essentially equal in regards to their PS ratio, even though they are radically different numbers. So I really hope that makes sense. If it doesn't make sense, feel free to comment down below and I will answer you. Overall, this author believes that SoFi is misunderstood in regards to their overall accounting ratios, including their PS multiple, also known as their price to sales ratio, and they are among one of the best investments in the overall finance space, and he believes that they are an undervalued gem once we discount their overall PS ratio, which is exactly what we were doing earlier. So overall, it seems that SoFi Technologies has a phenomenal future growth trajectory and that they are primed for future growth. But that's not all. There is even better news regarding SoFi Technologies. But first, let's go over a major problem that analysts are worried about, and that would be a SoFi stock headwind, which could be their crypto business. Now, clearly, this is not just going to go for SoFi Technologies. This is going to go out to essentially any financial institution that is trying to be relevant and offer cryptocurrency services. And the reason why this is a problem, at least in the short term, even though I think it's going to be ironed out in the future, is that the government is creating a, quote, novel activities supervision program, end quote, which is going to subject any type of financial institutions, specifically banks, that deal in cryptocurrencies and securities like that. And in SoFi's 8-K report, their management said that it would be forced to cease trading in certain types of assets, which essentially many people believe that they are going to be forced to stop trading in cryptocurrency due to it being a very volatile space in regards to legislation. But overall, I think this is extremely minor, and I don't see the same risk as these other analysts are saying. I don't think this is going to be a problem for SoFi Technologies at all, and the author even highlights that. He says, I don't think that the government moves against crypto will help SoFi or hurt it. So essentially, he's saying that SoFi Technologies is just going to roll with the punches here, and it's really not going to impact them that much. Although some analysts see SoFi Technologies as a very risky business, this author, as well as myself, just see it as a banking institution that also offers extremely competitive rates, very good products, an all-in-one inclusive app, and many other newer technologies and services that older traditional banks don't offer as of right now. Lastly, I also want to tell you that their margins are absolutely phenomenal, to where their margins came in at around 16%, which is more than double what their margins were a year ago. So this company is rapidly improving in their overall financials. They have very solid fundamentals. The company is on a great roadmap for future growth, and shareholders should hold this company over the long term, in my opinion. Now, with that being said, SoFi Technologies is also targeting young high earners who will eventually grow into major money magnets. And since SoFi is acquiring so many of these newer young high earners, they're just going to make more money in the future, and they're also not at risk of defaulting on any products or loans that they get from SoFi Technologies. So when we put all of this together, in my opinion, I would not advocate or allocate more than a 5% initial portfolio allocation to this company. 5% or below is going to be more than enough, but for me personally, I would invest a 1% allocation into them at first, and then dollar cost average weekly or bi-weekly or even monthly, given a certain dollar amount until that 1% reaches a 5% portfolio allocation. An example I normally give is if your portfolio is $100,000, you would be able to invest $5,000 into SoFi Technologies. You would write that number down at a 5% initial portfolio allocation, considering what your portfolio was worth at that time, and then you could invest $1,000 into it, and the next $4,000 you could invest into the company weekly or bi-weekly or monthly, so your overall averaged cost basis will be averaged, giving you a very competitive price for this company. And especially if you're willing to hold this company over the long term, you are primed for future growth. But once you max it out at around that 5% initial portfolio allocation of $5,000, I honestly would just let the rest ride for the long term, because this company should give you plenty of value. But with that being said, I would love to hear your thoughts down below. Don't forget to go and annihilate that like button. Subscribe if you are new. Don't forget to become a member of this channel to support me personally and keep me here on YouTube. And with that being said, I will see you in the next YT video.